Most business owners switch to an S corporation either too early and pay thousands of dollars in additional administration fees, or they wait too late and pay even more money in taxes for years on end. So yes, S corporations offer you major tax benefits, like saving money on self-employment tax, unlocking powerful tax deductions, and even creating more tax savings through things like fringe benefit plans, retirement plans, and more. But the major question most people have is, when exactly is the right time to make the switch to an S corporation? Well, my name is Sherman. I am a licensed CPA and the founder of mycpacoach.com, where we help business owners make these decisions every single day. And in this video, I am going to break down exactly when switching to an S corporation saves you money and when it does not. I will show you how to run the numbers yourself, common traps and mistakes to avoid, and potentially save you thousands of dollars in taxes from this video. So be sure to like and save this video, comment your thoughts below, and let's go ahead and jump right into it. Okay, so the question we need to answer here is simple. At what point do the tax savings from an S corporation outweigh the cost of actually running one? So let's start by helping you understand just how much an S corporation can save you in taxes. So the number one reason people switch to an S corporation is to save on self-employment tax. Self-employment tax is a 15.3% additional tax that applies to most 1099 or business income, whether you're a sole proprietor, single member LLC, multi-member LLC, partnership, or run an unincorporated trade or business. But here's where the S corporation becomes beneficial, because S corporation income is not considered self-employment income, which means it's not subject to self-employment tax. You would only pay that tax on the W-2 salary you take from the S corporation, not on the full amount of the business profits. And that is how it saves you money in taxes. For example, let's say you earn $170,000 in self-employment income. Well, in that case, you would be subject to about $26,000 in self-employment tax. Whereas on the other hand, if you had the same $170,000 taxed to you as S corporation income and you took a $60,000 W-2 from the company, then you would only be subject to about $9,000 in similar taxes, saving you almost $17,000. So to get an idea of how much money in taxes an S corporation may save you, simply multiply the amount of 1099 or business income you have by 15.3%. Now this would just be your starting number. Then we'll subtract your W-2 taxes and other fees that you may have here in a moment. But not before I show you another big way to use S corporations to save on taxes. So once you are an employee of your S corporation, you can also create additional tax write-offs through your S corp through reimbursement plans and benefit plans. For example, let's say you personally pay for childcare expenses, education expenses, home expenses, travel, and meal expenses that are related to your business, and even health insurance premiums out of your own pockets. Well, through your S corp, you could set up benefit plans that reimburse you for those expenses in a way where, number one, the payments are tax deductible for the business, and number two, those reimbursements are tax-free to you as the recipient. For example, you could set up a dependent care assistance plan to reimburse yourself for child care expenses you have or incur so that you can go to work. You can also set up working condition benefits to reimburse yourself for things like education expenses. You could also set up an accountable plan to reimburse yourself for home office expenses, car expenses, travel, and even meal expenses. Plus, you could also set up a health insurance reimbursement plan that would reimburse you for premiums that you personally pay for. So if you have these types of expenses, you should likely find out how much more money you would save in taxes if you were to set up these types of plans through your S corp when trying to determine if the S corp is beneficial to you. For example, if these plans allowed you to write off an additional $20,000 in expenses that you have, then that could save someone $6,400 in additional taxes who is in a 32% tax bracket. But now let's look at the other end of the spectrum here that many people neglect, which are the hidden costs associated with running an S corporation. So let's start with the most significant one, which is number one, your payroll taxes. So yes, while an S corporation prevents you from paying the 15.3% self-employment tax on all of your business income, you still have to pay the same amount of tax on your W-2 wages. Employees must pay 7.65% of their W-2 wages towards Social Security and Medicare taxes, and the employer must pay the same amount, which means when we add this together, you're still paying a 15.3% employment tax. It's just with proper planning, we can set an appropriate W-2 wage that is lower than your business income, which is what actually saves you more money in taxes. But that's not the only payroll tax that you pay. You are also subject to unemployment taxes on those wages, both on a federal and state level, which could add another $500 to $1,000 in additional taxes depending on the state that you live in. But then you also have to account for number 2, payroll subscriptions. In order to comply with the S corporation requirements, you must take a W-2 salary, typically through a payroll system. And running payroll can be very complex and costly if you do not know what you are doing. Generally, you have to run payroll, pay your payroll taxes on time each month or quarter, and submit payroll tax returns to the IRS and your state. Now, fortunately, a good payroll provider will handle most of this for you, but it could cost you another $700 to $1,000 in additional fees per year, which should be factored into your cost of running your new S corporation. And then we have number 3, tax return filing fees. S corporations are treated as separate entities for tax purposes, and therefore are required to file a separate tax return to your state and to the IRS through Form 1120-S. So now we have another tax return that we have to file in addition to your individual tax return, which means that you will likely incur more tax preparation fees. Now, reputable CPA firms may charge upwards from $1,000 to $2,000 or more to file an S corporation return, depending on its complexity. So this is also a cost that you should consider before you switch over to an S corporation. Plus, we have number 4, annual fees. So depending on the state that you live in, you may also be charged additional fees to run your S corporation. For example, states like California, New York, Tennessee, North Carolina, and many other states have what is called a franchise tax, which specifically charges additional taxes and fees to S corporations. And in addition to those fees, your state might also charge you annual registration fees to maintain the LLC or corporation that you are using to elect S corporation status to begin with. Because in order to form an S corporation or to be taxed as one, you have to first create an LLC or C corporation with your state to begin with. And most states charge annual filing fees to maintain those entities each year, which may add another $200 to $500 or more in additional fees depending on your state. So let's go ahead and add all of this up together and look at some scenarios here that will help you understand the best time to switch to an S corporation. So based off what we just said, let's just assume we have the following costs. $4,500 in payroll taxes on a $30,000 W-2, $500 in unemployment taxes, $1,000 in annual payroll costs, $1,500 in annual tax preparation fees, and another $1,000 in annual filing fees, which means we would incur at least $8,500 in costs to run our S corporation. And if the benefits of switching to an S corp do not exceed these costs, then it's too expensive. It's that simple. Now, of course, this is just a simple example. Your exact equation will look different based on a number of different factors, like your business income, the W-2 you plan to take from your S corp, the state you live in, and any additional taxes or fees you may incur by operating in your state. So instead of following cookie cutter advice to determine the best time to switch to an S corporation, just do yourself a favor and simply add up all of your S corporation tax benefits and savings and assign a specific dollar value to that. Then subtract all of your expected costs that you would pay under your S corporation and assign a dollar value to that. Then just see what your net outcome is. Now, in general, S corporations start to look, keyword, look beneficial once your business is earning over $50,000 in net income. However, that does not mean you should just switch over at that point. In many cases at our firm, we're able to find enough tax deductions and additional write-offs to reduce our clients' net income down to a level to where their self-employment tax is not as much as a burden to begin with. So before you go out there and start creating additional expenses to create, form, and manage this S-corp, first make sure that you've maximized all of the deductions available to you. And then once you have, do the math to see if an S-corp actually saves you more money when all is said and done. And if you need help with doing this correctly, just apply to work with my CPA team today at mycpacoach.com.